The rise of passive management does not invalidate the timeless drivers of bubbles. Valuations will still stretch, leverage will still accumulate, liquidity will still dictate cycles, and fraud will still emerge. What has changed is the market plumbing. With passive funds holding such a dominant share of assets, the mechanics of how capital enters and exits markets could exacerbate both the ascent of bubbles and the violence of their collapse. For investors, the lesson is not to shun passive strategies altogether. They offer low-cost exposure, broad diversification, and long-term benefits. Rather, it is to understand the systemic risks embedded in their scale. Monitoring flows into and out of passive vehicles, recognizing the concentration risks in index-heavy names, and accounting for the liquidity mismatch between ETFs and their underlying assets will be critical in anticipating how future sell-offs might unfold. In sum, passive investing introduces a structural factor that did not exist in the bubbles of the past, and this has changed the very architecture of markets. While history teaches that every mania ends the same way, optimism undone by leverage, liquidity, and psychology, the next crash may be distinguished by the role of passive flows. The scale of their impact remains untested in a full-blown crisis. What is clear is that passive management, for all its efficiency, has created new vulnerabilities that could make future downturns sharper, faster, and more synchronized than those of the past.
Subscribe to Santiago Capital Research on Substack today.